Hello folks, this is Jim Redder with Cloud Investments with an educational economic update for May 2018. In this month's video, I'll discuss some of the major headlines that influenced markets in April. I'll also provide insight into what these developments could mean for you as an investor. Please stay tuned at the end of this video for a required disclosure statement. Market volatility continued in April, but for the first time in months, all major indexes ended in positive territory. The Dow and the S&P 500 each gained 0.3% for the month, although both indexes were still down overall for 2018. The Nasdaq added less than 0.1% but remained up 2.4% for the year. The start of corporate earnings season was among the most important financial occurrences last month. By April 30th, the majority of the S&P 500 companies had released their first quarter 2018 earnings reports. Much of the news was positive as 79% of the companies exceeded expectations for their earnings. In fact, by some measures, the earnings season is the best on record. However, while corporate earnings results were strong, stock prices did not experience large jumps in response. For companies that beat their expectations, the resulting stock increase was on average about 0.3%. Why wouldn't strong earnings cause large equity increases? This may have happened in part because investors saw any quick stock price increases as opportunities to sell for profit. But with trade wars, treasury yields, economic growth, and more, investors had many topics on their minds. Let's briefly talk about how some of these topics affected markets last month. The possibility of a trade war between the United States and China worried many investors in April. Early in the month, one poll showed that over a third of financial strategists believed that a trade war was the biggest threat to the stock rally. By month's end, U.S. Treasury Secretary Steve Mnuchin was planning to visit China in hopes of preventing the trade tension from escalating even further. Yields on 10-year U.S. Treasuries were also a topic for many investors, which they tracked in April. For the first time since 2014, yields rose above 3%. This level is a psychological benchmark because rising above that rate can cause investors to leave riskier vehicles such as equities. By April 27th, yields had dropped back down below 3%. That same day, we received the initial reading of our first quarter gross domestic product. The economy experienced 2.3% annual growth between January and March 2018. That's slower than the fourth quarter of 17, but faster than analysts did expect. Looking back at April, both the economic data and the headline-driven news seemed to mimic the monthly performance that the index posted. There was a lot of action and talk, but the end result was to move just a little bit, but seemingly in a positive direction. That's it for this month's educational economic update. Cloud Investments will be moving to a new location on May 21st. You can find us at the Regions Bank Building at 200 Clinton Avenue here in Huntsville, 35801. And once again, this is Jim Redder with Cloud Investments signing off for the month of May 2018. Please remember that nothing we talk about here is a recommendation. If you would like to discuss your personal financial situation, please give us a call at 256-715-0094. We'd be happy to visit with you.
While we believe the information in this report is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or a solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decision. Advisory services are offered by Cloud Investments, LLC, a registered investment advisor in the state of Alabama. Insurance products and services are offered through Cloud Financial Incorporated. Cloud Investments, LLC and Cloud Financial Incorporated are affiliated companies. Investing involves risk, including the potential loss of principal. No investment strategy can guarantee a profit or protect against loss in periods of declining markets. The indices mentioned are unmanaged and cannot be invested into directly. Past performance does not guarantee future results.